Hey, what's up everybody? In this video I'm breaking down a powerful trading concept that can truly level up your trading, fair value gaps. It's simple, effective and a game changer in spotting strong opportunities. Let's dive in. So what exactly is a fair value gap? We also call it an FVG. In trading, especially in the ICT methodology, a fair value gap is an imbalance left on the chart when price moves sharply in one direction, as you can see right over here on those two examples, without retracing back. This gap shows where buy and sell orders didn't match up, leaving a gap behind that most of the time later price comes back to refill that imbalance. But not every imbalance is a valid FVG. So a valid FEG is a three candlestick pattern that created a gap. When we talk about the gap, we talk about the candle in the middle. This is the candle in the middle where I'm talking about. But that's not the only rule. There are some other rules. The wicks of the first and the third candle may never overlap each other. As you can see right over here, this wick and this wick do not overlap each other. So this is a valid FEG. I'll show you a bullish example. We got our three candlestick pattern that created a gap. We look at the candle in the middle. Then we look at the wicks. As you can see again, they do not overlap each other. So we do have a valid bullish FEG. In this case, what do we expect? That price comes back, retrace, refills the gap, and then goes higher. In a bearish scenario, I'm looking at the gap that price has left behind. Now we need to wait that price needs to come back to fill the gap. Wait, we need a touch in this gap, and then we can look for shorts. Here is an example why this is an invalid FEG and this is also invalid FEG, because you can look at the bodies and the wicks, and what did I say? They may never touch or overlap each other. If I take this wick and this wick, they overlapped each other. There is no gap that has left behind, so the market has no reason to come back. In this case, we are looking at the bullish scenario, and we have again our three bullish pattern, and we look at the gap in the middle. You can clearly see at the wicks. And what do you see? They overlapped each other, so this is also an invalid FEG. So why are those FEGs so important? They are magnets for price. Many traders view these gaps as areas where price will return back to. So if you are bearish, you don't need to enter right away. If price is here and we left an FEG behind, you wait for price to come back in this FEG, and that's where you enter. You place your stops above the high. You can aim for the middle of the FEG, but not always it goes like that. Sometimes we just tip the FEG and we dump. So entry here, stops above, and you aim for lower. In the bullish scenario, it's just the same but opposite. We got our bullish FVG, we expect price to go higher, but this gap needs to be filled. So we expect price to come back to here. We take our entry inside this FVG, stops below it, and we aim for higher. This can give you so many trades with good risk management you don't want to know. And it's actually really easy, guys. If you just understand and spot FVGs, this can really change the game for you. Here is a very good live example of using FVGs in your favor. As you can see, Bitcoin was accumulating on the 1 hour time frame, and after all we dumped. We left an imbalance behind, and it's a valid one because this week and this week did not touch. So we can mark this out as an FVG. Now, all we have to do is wait for price to refill this gap. All we have to do is just wait, and we need a touch in this gap before going lower. Why is this FEG important? Because many people didn't know about FEGs and they start selling here because, oh, I'm foaming, I have fear of missing out, I'm stressing of missing the move. No, you're not gonna miss the move because we left an imbalance, and if you know that price always comes back to refill this imbalance, then you know where to enter, and if you enter here you're gonna get stopped out or liquidated. If you just wait, you will see what happened. I'm gonna play this forward. Price goes higher to wick all those sellers out that's shorted here. No worries, like I said, we tapped in,
Now we can look for our short position. We place our stops a little bit above the uppermost of the FEG, and now we aim for sell side of the curve or the lows. In this case, this is a very strong low, and we aim for this. Let's play it out. As you can see, a very strong reaction. I'm very sure this low gonna be taken. There's a chance or possible, like I said, we left another FEG behind. Price can easily come back to here and then go lower. But she didn't, because this FEG was very strong and bigger, so she respected this one. Can you see how clean this trade is?
Before I jump to the next trading example, I just want to show you that there are also different types of FEGs. We also have the inversion FEG. Here you can see the normal FEGs, but in this case, price has to come back. She did, but she did not went lower. Instead, she went higher and closed above this FEG and created a new gap, a new bullish FEG. This FEG is so much stronger than this one, so this broke this last high, what created a market structure shift or a change of character. This means we are shifting from bearish to bullish. So if we tap inside this FEG again, you can start looking for buys. Here is a very good example of FEGs and why they sometimes not work, and there also are inversion FEGs. I'm gonna show you an example of this. As you can see here, price was bearish and left an imbalance behind. We expect price to come back to this imbalance as we did over here. We left an imbalance, price came back, continued to go lower. Here we left the imbalance, we expect price to come back to it to fill it, but we closed above with a big pump, what created also an FEG. This FEG, bullish FEG, crushed the bearish FEG. So in this case, this FEG is 10 times stronger. We also broke those highs, so this is a change of character, a torch. We also call it in trading, but that's for another video. But this means we are now bullish. As I said, don't enter right away. You can maybe aim for these highs and enter right of this bearish bullish FEG inversion. But as we talked about FEGs, in this case, to keep it simple, now we just wait for price to come back inside this FEG before we look for longs. And as you see, we did not take out those highs. We're just accumulating, ranging. We're almost touching it. Almost. We did not tap in, so still longs are invalid. We are building so much liquidity. This is a huge liquidity magnet that we can aim for later. This is what I wanna hunt if we tap inside our FEG. Let's play it out, and we tap right in. This is the area where I wanna look for longs. Place my stops below this FEG, and I'm aiming for those highs. Let's play it out. Tapped right in consequent encroachment. I don't know how you spell it or say it. It's just the middle of the FEG. Should run it. This is so clean. See the power of FEGs, and this FEG is so much stronger because it broke the bearish FEG. This is actually an EFEG. Some people wanna tell you to enter right away, but it's so much safer to wait before we come back, before this is all the liquidity that price has taken out now. This FEG is so strong, and this is a clear draw on liquidity. This is buy side of the curve. What I also want to say is, before I end the video, not every FEG works. You need to have a higher time frame confirmation or clear draw on liquidity. Why this FEG didn't work is because this FEG was our point of interest. Too many buyers were waiting for this FEG. This FEG is just inside the liquidity pool. This is all liquidity. This is a liquidity pool, and this is where buyers are waiting for. This FEG failed. Also, this FEG for seller sale fails. It tapped in to just reach our point of interest and then she skyrocketed. You can also see how clean this is. We move so smooth. And when you see this is shit. You can compare where big money is coming in. Everyone was buying here, while here buyers and sellers are fighting. So many traders lost money over here, while this is so clean. This is actually textbook. This is perfect. This is A plus. Keep in mind that the higher time frame draw on liquidity or a higher time frame daily bias is very important because not every FVG will work. You need to have a clear understanding where price is moving to and where to enter and where to exit. I will keep saying this, but if you understand market structure and the draw on liquidity, then you can use FVGs as an entry. An FVG is not everything you need. You need more than only an FEG. An FEG you can use for so much, but use it as entry possibilities or exit possibilities because also people shorted this FEG and they took profits over here. That's also valid, but this is much cleaner. So now you know what FEGs are and how you can use them. But don't forget and always remember you need to have a higher time frame confirmation or clear draw on liquidity. Without a daily bias or stuff that I just mentioned, FEGs are nothing. FEGs are just part of a solid strategy. Without other strategies, FEGs are nothing. So don't overtrade and don't go over every FEG that you see because you will see a lot of them. Here you can see the difference between a fair value gap, an inversion fair value gap, and a gap and just a volume imbalance. An FEG and EFEG you already know. A volume imbalance is the opening and closing of two candles. The difference between a gap and a volume imbalance is that the gap has a complete absence or gap between the candles, while a volume imbalance does leave a gap. This is an FEG, but this is a volume imbalance because we created a gap, but the wicks do overlap. I hope you enjoyed the video and I catch you in the next one.